Welcome back to EDS, and in this video I'm going to show you how to turn any account, even a small account, into a profit generating machine. It's going to pay you every day in theta decay, it's going to pay you every month, year, so on and so forth. So what you want to do is you want to pull up a list of futures that have options available to trade on them. Now we're not going to be doing the typical thing that you will see online, buying options, trying to turn a small amount of money into a large amount of money. We're going to be taking the other side of the trade, writing the options contracts. We're going to be short the options contracts. That lets us play as the house, as the casino, and the edge is in our favor. Now you're probably wondering, surely if we're going to have a very high win rate, etc., then how are we going to generate significant returns? Well, that's why we're using futures, because futures uses span margin, and that allows us to be capital efficient, and that's what's going to give us our high returns on capital. So once you have got this watch list open, if your broker doesn't display this natively, just copy the tickers and make your own custom watch list. Once you've got this watch list open, you want to make sure you have IV rank on there, and you want to order everything from high to low IV rank. This is because volatility plays a role on option prices. When volatility is high, option prices are high, and since we're going to be short, that means that we want to sell high, buy low. So we want to sell when volatility is high. Volatility is also mean reverting. It contracts in the market about 80% of the time. So this is just another way of building an edge on top of an edge. So once you have your watch list open like this, you only want to look at underlyings that have an IV rank of at least 30. Anything over 30 can be considered high, over 50 can be considered very high. And then you want to go down the list and see what would fit well in your portfolio. If you do have a smaller account, you probably want to stick with things like currencies, bonds, soybeans, etc., because they don't require as much buying power as some other stuff, such as, say, crude oil. But if you have a larger account, feel free to trade whatever you like. Just keep your portfolio nice and diverse. So we're going to take a look at the corn futures /ZC. It has an IV rank of 55.2 and an absolute IV level of 23.7%. So once you've selected your underlying, we're going to go over to the trade tab, or it might be different for your broker platform, but basically you just want to see a list of option expiration dates, and you want to pick one that's between 30 and 60 days out in time. If you've got a choice from multiple, pick the one that's closest to 45 days. In this instance, we only have one to choose from, April 25th, which is 57 days out. So we're going to open that up, and now we are presented with the options chain. So here, very quickly, we have calls on the left, puts on the right. This horizontal orange line shows us where the price of the underlying is with respect to the strikes. We have our dotted blue lines that show us our standard deviation levels. And if you look in the top right, we have our implied volatility, which is at 46.8%. This is specific for this expiration date. And in parentheses next to it, we have the expected move, so plus or minus 31.11. That's also visually displayed by this vertical orange bar, and that's going to be very useful for us. And then you also want to make sure you have delta shown on your options chain as well. There'll be positive deltas for the call side, negative deltas for the put side. So when you're writing and selling options contracts, you want price to stay away from your contracts. Okay, it's the opposite to if you were to buy these contracts. So if you were to buy these contracts, you want price to move in the direction and breach your strikes if they're not already in the money, and you pay a premium. We're going to take the opposite side of the trade, so we're going to collect a premium up front, and we want price to stay away from our contracts. So if we know what the expected move is, all we need to do to get a high probability of success is sell outside of the expected move. And here's the trade-off. So the further outside the expected move you go, the higher your win rate will be, or the higher your probability of profit will be. However, the less premium you will collect, and therefore the lower your return on capital. So you want to be in a nice kind of mid-range sweet spot, and for me that's near the 1 standard deviation level, or more specifically between 15 and 20 deltas as a good starting point. So we're going to have a look at the 20 delta here on the call side. So the 20 delta lines up with the 525 strike. We're going to sell that, and then we're going to do the same thing on the put side. 20 delta that lines up with the 455 strike, and we're going to sell that. So if you take a look at this position now, what you'll notice is that we have basically created a range for ourselves, and we want price to stay within this range. And as long as price is within this range at the point of expiration in 57 days time, we're going to keep all of the premium that we collect up front. However, quite often we will be getting out of this position early, and that's going to increase our win rate. So if we look in the bottom left corner, we have a pop of 37%. This seems completely wrong. This is way too low. But if you are getting some weird number like this, then you do just want to look at your deltas. So your delta, there's two functions of delta, but one of the functions of delta is it shows you the likelihood of the contract being in the money at the point of expiration. So the likelihood of this call contract being in the money at the point of expiration is 20%, because the delta is 20, and it's the same thing on the put side, so 20%. So overall, you have 40% chance of either one of these contracts being in the money at the point of expiration. That means we have a 60% chance of these contracts being out of the money, which is what we want. So we've got a 60% chance of success here. However, if you have a look at this green bar, it will show you your break-even level. So, what you'll notice is that this green bar hangs past our contract strikes, and the reason why is because we collect a premium up front, and we keep that no matter what happens. So we have to add on our premium to our strikes to get our true break even. So 525 plus our premium here, which is 9.125, and that's how we arrive at this green bar level here. And on the put side, you do the same thing, but the inverse. So 455 minus 9.25, that's just increased slightly, and that's how you get this green bar here. So even though we have a 60% chance of our contracts being out of the money at the point of expiration, we don't need our contracts to be out of the money at expiration, because our break-even zones are further beyond our contract strikes, if that makes sense. So let's say, for example, if price is at 450 at the point of expiration, well, technically our 455 strike is going to be in the money. However, we're still going to make money. We're still going to be profitable because our break-even zone is below that. So that's one reason. That's another reason why we have the edge in our favor. So even though our chance of being out of the money is 60%, we have to factor in our break-even levels. So in reality, if you have a look here, so for example, we're basically at the 445 strike, which is at about 15 delta, and we're almost at the 535 strike, which again is at about 15 delta. So 15 plus 15 is 30. You do the inverse of that, minus 100 even, or whatever, however you want to work it out. So we have so that works out to be a 70% chance of making profit on this trade. So a 60% chance of our contracts being out of the money, but a 70% chance of making at least 1 penny on this trade, basically. Now, if you want to get out of this position early at say 50% of max profit, then your P50, which is 50 probability of hitting 50% of max profit, is typically going to be about 10 to 15% higher than your probability of profit. So if we've got a probability of profit of 70%, our P50 is going to be about 80-85%. So we're looking at probabilities of success of between 70 and 85%, depending on how long we want to hold this position. 70% if you hold till expiration, 80 to 85% if you get out of 50% of max profit. And if you want to get out of 25% of max profit, you're probably looking at 90% plus. So what is our profit? So once you multiply out this fill price by the contract multiplier, which your broker will automatically do, you'll get this max profit here, $456.25. So that's how much we collect up front as soon as this order gets filled. So if we were to hold till expiration, and our price is in between our range here and our contracts are out of the money, we keep 100% of this premium. So we would keep $462. We collect it up front and we keep it, and that's it. Trade done. If we get out 50% of max profit, it'd be 50% of this number here, $462. If it's 25%, it'd be 25% of this number here. Okay, and our broker is going to require $748 of buying power to open this position. So we're going to collect 450 and we're going to use 750 to open this position. So as you can see, we're getting over a 50% return. This is in 57 days time, Very, very high return on our capital with very, very high probabilities of success. So I'm hoping that you can start to see now how you can compound this and very, very quickly build up your account. We also have this number here, 9 theta, which is your theta decay, which is 9.998. So basically that's 10, right? So that's basically telling you, assuming all things are equal, once you're in this trade, you're going to get basically $10 of daily theta decay. That's how much money you're going to make per day, assuming all else is equal. This is 57 days out, and as it gets closer to expiration, that theta decay becomes more and more aggressive, so that number is going to increase more and more and more exponentially, assuming all else is equal. Obviously there's other factors at play, there's other Greeks at play here, but you get the point. So we're getting daily theta decay, right? So not only are we getting daily theta decay, we're getting a high probability of success, we're getting high returns on our capital, and it's in a relatively short period of time, 57 days. And this is one position. You want to do this as many times as you possibly can within your risk parameters. You want to have as many occurrences as possible to eliminate any short-term variance. And this is just a very vanilla plain position. Once you get more advanced, let's say, for example, if price just drops to 420, you don't have to just take a loss. You can do things like roll the call side down. You can buy the guts and sell the wings and rebalance your deltas, and then move your strikes out again. So when your strikes get too close, you can just buy the guts and sell the wings and move your strikes out again, and roll the dice, and keep doing that over and over and over again until eventually you win. You can only really do this on naked positions like this. Naked meaning that there's no long contracts covering your shorts. This would be an example of a long position. As you can see, we have long contracts covering our shorts, but you don't really need to do that because our buying power requirement is so low in the first place. But that's basically it. I mean, if you want to be more conservative, you can go to, say, the 14 delta on the other side as opposed to the 20 delta. You are going to collect less premium. Your buying power requirement is going to be less, but you will have a high probability of profit. I like to be around the 20 delta mark. It's just a good balance for me. But that's basically what you need to do. You need to do it again and again and again, over and over and over, and just let the money accumulate in your account, basically. So how do you know how much buying power to allocate to your positions? How do you know how to keep your risk in check, etc.? Well, in order to figure that out, we've created a free position sizing template. The link is in the description. Just click the button and it will take you over to the spreadsheet. The way it works is you enter in the size of your portfolio. So we've got $25,000 as an example there, and then you enter in whatever the current VIX level is. Say if it's 21.1, and then as you see, everything is calculated for you. It calculates these numbers dynamically based on the size of your portfolio and the VIX. The VIX is just showing you the volatility in the market. When there's more volatility in the market, our edge is higher, so you can be more aggressive. And also, the higher the VIX is, the lower the chance of a black swan event happening. And so that's another reason why you can be more aggressive. So just follow this, you'll be absolutely fine over the long run. If you do want to learn in more detail, click the link in the description. This time click on EDS Premium, get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments. If you remember just a couple of minutes ago, we were talking about how, even in a losing position scenario, how you can make adjustments, roll your contracts down, up, out in time, basically reset the odds again and roll the dice again, give yourself another chance to be correct. All of those kind of adjustments, everything is all included in these portfolio updates, and it's all in real time. There's no delay, so you can just copy it or use it to study whatever you want. There's also a full course, so no prior knowledge is required. We're going to teach you everything that you need to know from start to finish. It's a private community, so if you do get stuck, you can just speak to myself directly or with other like-minded individuals. There's a 100% money-back guarantee, so once you have been through the full course, followed some of our trades for at least 6 months, if for whatever reason at that point you're not profitable, then we'll work with you for free until you are, or you can just request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price used to be £1 a month. That was for the first wave of members. That's now full. We're on the second wave of members. Once this second wave is full at $9.99, the price will be increasing for the third wave of members. Once you're in, the price is locked in for you for life, so you don't need to worry about future price increases. So you are definitely rewarded for getting in early. The aim of EDS Premium is we want to teach you the skill. We don't want to keep you dependent on us. We're going to teach you the skill. Once you've learned it, you can take it with you forever. No one can ever take it away from you. It's a very powerful thing to know and learn. and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months you will be good to go. So with that being said, I will see you guys on the inside.